everyone, my name is Emily and welcome to another video. Today we're going to talk about automated trading systems. Automated trading systems, also referred to as algorithm trading, involves the use of an algorithm to execute trades according to the predetermined criteria. The systems allow traders to establish specific rules for both trade entries and exits. Once these are programmed, they can be automatically executed by a computer. The benefits of automated trading include more trading uptime, minimizing the impact of emotions during the trading process, and faster execution. To get started with automated trading systems, you need to decide whether you want to build your own system or use a third-party algorithm. If you build your own system, you can choose every aspect of the strategy and have a better understanding of how the system works. It could open and close trades based on timing or price, using technical indicators to confirm your entry and exit points. For example, you could build a system to automatically buy 100 Netflix shares when its 50-day moving average goes above the 200-day average. Or you can automatically sell 100 Netflix shares if the market reaches volatility levels you are not happy with. If you are not confident enough to build your own system, you can use a third-party solution instead. This works in a similar way to a self-built system, opening and closing trades according to set criteria. However, you will have less control over the customization of these parameters. Whether you build your own automated system or use one which has been pre-built, it's important to backtest it thoroughly to make sure it works in the way you want before you put it to work on the live markets. MT4 is popular if you want a third-party solution because MT4 provides a marketplace where you can conveniently access pre-built algorithms to get started with automated trading. It's important to note, though, that automated trading systems have some downfalls that you should be aware of, like the possibility of mechanical failures. For instance, if an internet connection is lost, an order might not be sent to the market. Automated trading systems need to be monitored because of the potential for technology failures, such as connectivity issues, power losses, or computer crashes. Automated trading system can experience anomalies, which could result in wrong orders, missing orders, or duplicate orders. If the system is monitored, then situations like this can be identified and resolved quickly. Thank you so much for watching us today, guys. Bye-bye.
So first, today we're going to be talking about preparing for earnings season. We're just going to go through a couple of tips and what this means for you as a trader. Okay, before we get started, as per usual, we're just going to go through the risk warning and disclaimer. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So our disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, hi everyone, I'm Melanie and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. Firstly, we'll briefly talk about what exactly US earnings season is and what we should do to or what specifically we should watch out for and how we can trade them. And we'll also go through some risk management strategies as well. Okay, so what is the US earnings season? The earnings season is the period of time during which a large number of publicly traded companies release their quarterly earning reports. So in general, each earnings season begins 1 or 2 weeks after the last month of each quarter. So December, March, June, and September. So what does this mean for investors? So this is basically a very active time in the market, as participants such as yourselves, analysts, traders, investors, review the earnings reports, which may affect their positions on or in a company. You can often see a lot of movement in the shares of companies releasing reports as the market reacts to the new data. So it is not unheard of to see shares jump 20% or more or to see them fall by the same amount. So it's also a highly active time for the financial news media, such as CNBC and the Wall Street Journal. There is extensive media coverage of the major earnings releases, from a general recap of the earnings to a report on whether the companies missed, met, or beat analyst expectations. So some traders look forward to the earnings season as it can be a period where they confirm the positions they have placed. For example, shorting a stock before earnings and watching the price drop can be beneficial, as the psychological drop will usually trigger a sell-off. Conversely, a ramping up in production or revenue could result in a swift upward trajectory or stock price. So other investors sit out the season entirely, as there are too many human factors at play. So there's just some things for you to take note of as well. So for this year, July 2023, the second quarter earnings season has begun in earnest during the second full week of July, led by banking giants JP Morgan, Chase, Wells Fargo, and Citigroup. Analysts at US financial data group FactSet estimate an earnings decline of negative 7.1% for the S&P 500 companies, which will mark the largest earnings decline reported by the index since the second quarter of 2020. Okay, so this is the update or the current situation that we are facing. What exactly can you do to, as we await more earnings report releases? So these are just 3 tips or 3 things that you can keep a lookout for. So firstly would be the performance of bellwether stocks. Second, earnings recession, as well as thirdly, the earnings and stock index weighting. So there are a number of factors that you can look out for in companies' earnings reports, but traders should be the most mindful of performance of the largest bellwether stocks, as well as understand the significance of an earnings recession in a given stock and grasp how a stock's earnings announcement might impact a relevant index depending on the weighting of the given security. So we might go and look into DXY as well later on after we are done with our slides. Okay, so let's get into it. Firstly, we have performance of bellwether stocks. So some examples of bellwether stocks would be FedEx, which most of us are familiar with. It's a shipment company for consumers as well as businesses internationally. Next, Caterpillar is the world's largest heavy-duty machinery maker. It's viewed as bellwether given that it has a large exposure to construction, manufacturing, and agricultural industries, particularly in China. 3M, gauge for the health of the manufacturing sector, as well as Apple, which we are all familiar with. So when analyzing company earnings, it's important to look out for these stocks similar to these, because it can be seen as a gauge of the performance of the macroeconomy. So while the status of a bellwether stock can change over time, the largest and most established companies are typically considered a bellwether stock. So these are the examples that we've given, but of course there are others as well. Okay, next we have, we should look out for the earnings recession. So what exactly is the earnings recession? It's basically categorized as 2 consecutive quarters of year-on-year declines in company profits. So it's important to note that while earnings are an important factor in the stock market returns over the long term, an earnings recession does not necessarily coincide with an economic recession. So the chart that I've included here from Thomson Reuters data stream shows that in the past 6 earnings recessions witnessed in the US, only 2 had coincided with an economic recession. So the blue circles that you see here show where there was an earnings recession without an economic recession, while the red circles represent where both earnings and economic recession occurred simultaneously. Okay, next we have the earnings and stock index weighting. So traders should understand that when trading earnings, certain stocks will have a greater impact on the wider index according to their index weighting. So the example that I have here is when trading the Dow Jones. Boeing releasing its earnings will be highly influential on the index, while Visa likely won't be as influential. Why? Because of its former's 9.49% weighting compared to the latter's 4.1%, which you can see in this table that I got from dailyfx.com. So this really highlights the importance of paying close attention to bellwether stocks and how they may impact a broader equity index. Okay, so how exactly are we going to trade using all of the information that we have? So we've simplified it into 3 simple steps. Firstly is to select a specific company to focus on, or set of companies. Secondly would be to do your research, and thirdly would be to formulate a trading strategy and follow it. So firstly, choose companies to focus on. This is pretty straightforward. It's advisable for traders to go for a small number of companies, perhaps stocks that you are already familiar with or trade already, and find the dates on which their earnings will be released. So large bellwether stocks are worth investigating whether one is trading them or not, as the impact of their results can impact wider industries as well. So when you're deciding on the stocks to go for, traders should understand that the relationship between an earnings result and subsequent price reaction is not always straightforward. So for example, if there are better than expected earnings, that normally indicates a bullish bias, but it does not always translate to immediate price gains, and the opposite holds true as well. So the example I have here from DailyFX as well is Walmart's strong earnings in the 3rd quarter of 2013 or 2018. And this is failing to excite market participants. So while encouraging, a quarterly report is more than last quarter's results compared to expectations. So analysts are often much more concerned with the future expectations of the firm, as price is a forward-looking metric, with future earnings being calculated in current prices. So if we think about it that way, then it becomes much more reasonable when investors like yourselves perhaps shy away from a stock with strong results for the past quarter, but an abysmal outlook for the future. So weaker outlook can seriously undercut a stock's current valuation as well, regardless of past performance. Okay. Next, we have doing your research. So this ties nicely with our fundamentals analysis as well. So doing your stock research properly will involve looking at estimated earnings for your chosen stock. It also involves comparing these earnings with the analyst's expectations. Traders should also make sure that they look at historical figures to get a feel for how the market has responded to releases in the past. So while earnings season is typically thought of in terms of what the results mean for a single stock, the season as a whole can also offer important takeaways. So one such takeaway is information is offered on a company-specific basis, but common themes can ring true throughout. So one such headwind would be our recent coronavirus, or perhaps geopolitical tension in specific areas. So these can combine to form a wave of worries across all sectors or specific sectors, if the impact is big enough. So traders should investigate how such headwinds impact on one sector or stock compared to the others. So another example would be perhaps many industries suffered greatly during our pandemic, but March 2020 saw Greece-based tanker vessel operator Topships Inc. experience a surge in product demand in areas such as cleaning supplies as well as paper products, leading to increased shipping requirements. So this in turn created higher trading volume and volatility. Okay. Lastly, formulating a trading strategy and following it. So formulating a trading strategy for earnings season should include a methodology for entry and exits, profit goals, time spent trading, and a risk management plan. Trading earnings reports is typically difficult and risky. So for some, trading around the event may not suit their risk profile. And so any position taken should be adequately hedged and definitely include a stop loss. So with that said, volatility can of course also create unique circumstances. So it can also provide opportunities for a few specific strategies as well. Okay, when formulating a strategy for earnings season, traders should be aware that quarterly earnings are capable of seriously uprooting an ongoing price trend due to their relative infrequency and importance. So this often causes traders to position for severe price swings, evidenced by heightened implied volatility. So we'll go through a couple of stop loss strategies or risk management strategies that you can implement into your trading strategy as well. And these are not specific to only earnings season or stocks, but of course, for Forex or your commodities as well. Okay, so firstly, we have the most basic, which is proper stop loss and take profit placement. So proper stop loss and take profit placement is crucial to ensure that you maximize your wins and minimize your losses. So for stop loss, it should be placed beyond the resistance area, while take profit should be placed before. Okay, here is just an example for you to look at as well. Okay. Here we have trade management with confluence. The confluence that we're talking about in this case is referring to Fibonacci confluence. But if you have a couple of support levels lining up, resistance levels, those are considered confluence as well. So firstly, stop loss should be placed beyond, as we saw earlier. And this basically means that you should always put your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. Okay, as for take profit, we always recommend to place it before a key confluence area. And the reason for that is because when price reaches a confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry instead, or even worse, your stop loss. This is also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 or 2 pips. Okay, now we take a look at a couple of dynamic take profit placement examples, just to show you guys a couple of real life price examples. Okay, so here we have a negative 27.2% Fibonacci expansion that lines up nicely with the 127.2% Fibonacci extension. Okay, you can see this over here at this blue highlighted area. So that's where we've placed our take profit. And as for our entry, we've placed it at this overlap area. So an overlap resistance in this case basically means that you have a swing low that lines up nicely with a swing high. Okay, so our entry is a pretty strong level since price has tested it many times before. And then our stop loss is just at this swing low here. So the take profit, we've placed it above the confluence area. And you can see when price moved up, okay, this is the before, right? We're expecting price to bounce off of the entry and hit towards our take profit. But in this case, we placed our take profit before the confluence area. And you can see it reversed off and it missed our take profit by a couple of pips. Okay, it did exactly what we expected it to do, but it reversed off because of the strong resistance area over here. So in this example, we place the take profit under it instead or below the confluence area. And you can see price hits our take profit nicely before reversing back down to our entry. Okay, so that's just one example of a risk management strategy. The next example we're going to be talking about is break even. So just really quickly, because this is not a risk management webinar, but we're just giving you some examples of how you can implement this into your trading strategy for earnings season as well. So break even is a level where you are in profit and recognize that there's a risk of a reversal back to your entry. So it's basically you saying, if I'm right, price should go all the way to my target, but if it goes back to entry and you are wrong, then you should get out. So firstly, we have our entry. So our entry is over here at this blue dotted line right over here. So we go in for a buy at this double swing high resistance. So it goes up and then it fluctuates a little bit, and then instead of shooting up towards our take profit, which is represented by this green area here, instead of going all the way up, it actually reversed down. So when it reversed down this specific area here at this swing high, level is our break even. And it's our break even because we see price reverse back down. So we panic and then we put our stop loss originally is here, but because it reversed over here, we want to place our stop loss over here instead. Okay, and then it reversed off, it hit it back up, and we think maybe there's a possibility that price is gonna hit our take profit here, but it doesn't. It reverses down, and you get stopped out here. But it's fine because even though price has, or rather price you've been stopped out, but you still you didn't make a loss in this case. Okay, I hope that was clear what exactly a break even is. Okay, next example we want to talk about really briefly is idea invalidation. So idea invalidation is usually placed before your stop loss. It's the level at which you basically admit, I'm wrong, let me get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So in this example, once again, we are entering from here at this level here with the two swing highs, and then price reverses down and we expect price to continue downwards to hit our take profit. But it doesn't, and it reverses and hits back up. So it hits back up and it even surpasses our entry, continues upwards, and then our original stop loss line was here. But instead of moving our stop loss in this case, we add an we move our take profit instead. Okay, so what we mean by this level, the purple level, is our idea invalidation level, is that it's basically at this point where we realize that we want to get out of the trade. Okay, so it reverses off and it hits our take profit nicely. Okay, but if we didn't modify our take profit and we just left it over here, it would have reversed and shot back up and hit our stop loss instead. So we got out here at break even before price rose further and stopped us out. So idea invalidation involves moving the take profit, whereas break even, as we saw earlier, involves moving our stop loss line. Okay, I hope that was clear. We go more in depth into the different kinds of risk management techniques in our risk management webinar series. So you can stay tuned for that if you've missed those before. But yeah, this is just a brief run through of some of the techniques that we use. Okay, so just a bonus slide, some tips for you to take note of is to firstly know the expected results. So keep up to date with the releases. Secondly, stay alert to surprise announcements from the respective companies. Thirdly, be aware of spillover effects between stocks, since especially for stocks within the same industry, a release of one stock can definitely impact the earnings report of another. Next, consider volatility over the bearing of an expected move. So you should definitely be aware of what the expected number is, as we mentioned earlier, and then be careful, or rather take note of whatever volatility that follows the release of the earnings reports. Okay, and that is all for our slides. Now we're just gonna get into some of the setups for this week. So we have a request for Brent oil. I think we'll look at DXY as well, since we're talking about the US earnings report as well. Okay. So we'll do Brent oil first. And if there are any other requests, let me know in the chat. Okay. Okay, let me just check to see if you guys can see my chart. Okay, all good. Okay, let's get into it. So as per usual, we want to look at the higher time frames first, just so we get an idea of where prices are headed. So the general direction is pretty bearish on a weekly time frame, and on our daily time frame as well. Let me see if we have a trend channel on our. Okay, price is moving in this, or rather, price has broken out of this descending trend channel on our daily time frame. Okay, so this gives us a bit of a bullish bias. So let's take a look at this on our 4-hour time frame. Okay, it's pretty bullish as well on the 4-hour time frame. Okay, no trend channel. Let's see if we have a trend line. Okay, yeah. So remember, for a valid trend line, there has to be minimum 3 touches on the trend line. In this case, we definitely have 3. Okay, so let's get into our support and resistance levels. Okay, so for my first resistance, I'm going to place it at the closest swing high to where price is currently at, and I'm going to try and pull it all the way back as far as I can without cutting too many candlesticks. Okay. And then first support level will be over here. Second support maybe here. And second resistance here. Okay, now that we have these levels, I'm going to go in with some Fibonacci levels. So for a Fibonacci retracement, which is what I'm looking for here, we use these 5 levels. So I can see my 78.6 lines up nicely with my first resistance. Yeah, that's all. Next, I'm looking for a projection. So for Fibonacci projection, we use these 3 levels. And I can see my 100% lines up nicely with my second support. Okay, my 61.8 also lines up with my first support. And I'm looking for another retracement here. Okay, and my 38.2 lines up with my first support as well. Okay. Okay, I'm just looking for a extension here. Okay, and my 16, so for Fibonacci extension, we use these two levels, 161.8 and 127.2. And my 161.8 lines up with my first resistance. So you can see that I already have this huge area of resistance here because I have so many levels that line up. Okay, another thing, if you guys are wondering what exactly is a Fibonacci extension, it's basically when we call it the Nike tick retracement. So when you have a shape like this, or perhaps if it's inverted, it will be like that. Once it has retraced 100% of the head, then you can use this method, and it's to project where prices are going to bounce off of. So it bounced off of the 161.8 as we can see here. And earlier I used the 127 as well, but it was over here, so it didn't have any effect. Okay, that's for extension. Let's see if we have anything else. Okay, okay, no. Okay, that's all the Fibonacci levels that we have here. So we can see this huge confluence area here is what is pushing price downwards, but it's not likely to, or rather we don't see any signs of price breaking out of this ascending trend line. So even though it is a bit bearish over here, we can expect it to hit towards maybe this our first support level here, but probably no further than that. Why? Because of this ascending trend line, but also because we have the 61.8 and also the 38.2 Fibonacci retracement. Okay, so now let's pull in some indicators to support this. So Ichimoku price is moving above the Ichimoku cloud, giving us a bullish bias. MACD is also giving us a bullish. Okay, I accidentally clicked on the SMA, but it does look like price is breaking out of it. So it's breaking out of our moving average, and it appears to be moving below it instead. So it's giving us a bit of a bearish bias. Okay, and then over here we have a bit of a bearish divergence as well. So price is making a higher high on our price chart, and price is making a little bit of a lower high on our RSI. Okay, so I'm going to go ahead and remove Ichimoku and MACD because it doesn't support our analysis. Okay, yeah, I'll definitely look into gold as well. Okay, so here is our analysis for Brent. So we're expected to drop from the first resistance towards our first support, but probably no more than that because of the confluence and because of the trend line. Okay, next, let's take a look at gold. Okay, same thing, we're gonna look at the weekly time frame first. Prices are pretty, okay, it looks like prices are headed upwards, quite bullish over here. We have 3 swing highs, but apart from that, nothing else. Okay, here's our daily time frame. Okay, we have an ascending trend line here. Okay, let's see. So pretty bullish on both the weekly as well as the daily time frames. Okay, let's take a look at the 4 hours as well. It looks like prices just broke out of our descending trend channel on the 4-hour time frame. Let's see if we have a channel here as well. Okay, no. Okay. So we don't have any channels or trend lines, so we'll just go ahead and start off with our support and resistance levels. So here's my first resistance, closest swing high to where price is currently at, and then swing support level is at the closest swing low. Okay, I'm just gonna highlight this level as my intermediate support level. Why? Because we have seen that price has tested this level many times. Okay. Yeah. Okay. So we're likely seeing a buy towards our first resistance over here. Okay, let's see if we have any Fibonacci levels. Okay, are my 23.6 and 38.2 line up nicely? And okay, my 78.6 Fibonacci projection also lines up with my first resistance. Okay, my 50% lines up. Okay, what else? Okay, I think that's it. So now that we have these levels, let's go in and look at some indicators. Okay. Ichimoku isn't really telling us anything now because it's moving within the cloud. But it does look like it's breaking out and moving above, but only when it's moving above then we can confirm that it's bullish. As of right now, MACD is also bullish. RSI. Okay, we have another divergence over here. Okay, price has made a higher low. Whereas on our RSI, it's made a lower low. So we could be seeing price continue to drop because this is a bearish divergence here. Okay, but on our SMA, it's moving above the line as well. Okay, so in this case, we can probably expect price to continue to go up towards our first resistance here. Because of all the upward pressure we've seen on the daily and weekly timeframes that prices are pretty bullish, and we want to trade. We normally like to follow the general direction of price. And on our SMA, we can see price is bullish on our MACD as well. But our RSI doesn't support our analysis, so I'll just remove that. And then we can also keep an eye out on our Ichimoku indicator as well, because it does look like price is breaking out over here. Okay, and then with all of this support area here with the multiple swing highs, the 23.6, we are not expecting prices to continue to drop to this level. It's likely to continue to push it up towards our first resistance. And our first resistance also is a pretty significant level with all the swing highs as well as the retracement level. So it's likely to attract price towards that area. Okay, that's all for gold. I think we have time for maybe one more chart. So if there are any requests, feel free to let me know in the chat. You're fine. Okay, sure. Okay, weekly time frame, it's pretty bullish, bearish, as you can see. Okay, daily time frame, pretty bearish as well. Okay, on our 4-hour time frame, definitely bearish as well. Okay, let's go ahead and add some support levels. Okay, now let's see if we have any channels. Okay, I don't think so. Trend lines, maybe. Okay. So we have our first support. Let's go in with another level. I have a resistance here, first resistance. Okay, it's a bit hard to analyze on this chart because there are no previous levels for us to take note of. So we're just gonna jump right into our Fibonacci levels. Okay, so earlier I mentioned Fibonacci extension. So we're going to take a look at okay, I have my first resistance here. Okay, my projection level lines up nicely, as well as my 100%. Yeah, I'll maybe get rid of this intermediate support. So I remove my 127 as well. Okay, let's see if we have any other levels. Okay, I think this level over here will be my second resistance. Okay, in line with the 78.6 and also the swing low over here. Okay, I'm gonna add my first support over here. And then this will be my second support, just because it's a bit closer to where price is currently at. Okay, now let's go in with some indicators. I'm pretty sure everything will be bearish. So we have price moving below the Ichimoku cloud, bearish and bearish as well. Let's take a look at RSI. Okay, all pretty bearish as well. Okay, so we can expect price to continue moving downwards towards our first support. because of all of the downward pressure from this descending trend line. Excuse me, from this, let me highlight it. This resistance area, because of the confluence area as well, 61.8 Fibonacci projection, and also the 161.8 Fibonacci extension. So we have that. And also our indicators all giving us very bearish signals. So we can expect it to continue to drop to our first support. Okay, that's all the time I have for today. I hope you guys found it helpful and learned something today, and I will see you guys next week. Thank you guys. Have a great rest of your week. Bye. Thanks, Fan. Thanks, Yuha. Bye. See you guys next week.
Good day, welcome to another quick deep dive video. Today we'll be talking about financial instruments, what they are and the different types that exist. To start, a financial instrument is a contractual monetary asset. Think of it as a real or virtual legal agreement with monetary value that can be traded, purchased, modified or settled. Financial instruments are typically divided into three types: cash instruments, derivative instruments and foreign exchange instruments. Cash instruments are financial instruments that are directly impacted by market conditions. Examples of cash instruments include securities like stocks, bonds or options which are traded on the stock market, or deposits and loans which represent monetary assets agreed upon by borrowers and lenders. Derivative instruments are financial instruments that derive their value from an underlying asset, for example, interest rates, indices or other assets. Foreign exchange instruments are considered unique. They are financial instruments represent on the foreign market. They are comprised of derivatives and currency agreements. Currency agreements are themselves subdivided into three categories: currency swaps, outright forwards, and spots. A currency swap is the buying and selling of currencies with different set value dates. Outright forwards are currency agreements in which currency exchange occurs prior to the date agreed into the agreement, and a spot in a currency agreement in which the actual exchange of currency happens no later than the second working day of the agreement's original date. Financial instruments also have two classes of assets. These are known as debt-based financial instruments and equity-based financial instruments. A debt-based financial instrument is usually used as a tool to increase the amount of capital in a company. This includes bonds, mortgages, debentures, credit cards, and others. Equity-based financial instruments normally represent legal ownership of an entity, for example, stock. Thank you for watching.